Welcome back, investors, to Ticker Time News. I am Adam, and we made a bunch of calls yesterday during the live stream, and I've got to say, a bunch of them came true, but I was completely wrong on one of them. Like, I missed one completely because I think it is completely disconnected from this reality. We'll look at that one in just one moment. Now, following yesterday's higher finish in the market, the stock market shifted into retreat mode today. Just look at this screen. I'm going to hide my in the green today. So we'll take a look at energy. I also want to talk about, whoa, am I muted? I hope not. Was I? Uh-oh. 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 No sound? Let me know. Do you guys hear me now? I thought when I took my okay, is everything okay, all good now. Okay. Whew. Had me worried, had me very worried. I thought that my voice could stay connected. I wanted to remove myself for just a moment so you could see what I'm blocking, because Apple, which is a big one, it is like right where should I be pointing? Let's get the finger right over right here. Apple is right there, so I didn't want to hide it because that's obviously the biggest market cap name out there. But anyways, let me just recap now that I'm back and you got sound. The market got destroyed today, kind of, as expected. We talked about it yesterday. We got Microsoft down 3%, Alphabet down 2%, Apple, which I'm hiding, it was down 1%, Nvidia down 3.3%. You've got Amazon down 3.4%. You have Tesla down 2.9%. So everything was like down, red, all across the screen. You've got United Healthcare here down 2%, which is a big one. When I hid my face, the voice went too. Okay. Now I know. On my end of the screen, it shows that volume was still kicking when I was talking. So I thought I could do that, but I guess I can't. Lessons learned live during a live stream. Isn't that something? Okay, but the only thing that was green, really, XOM, ExxonMobil, and ticker CVX, which is Chevron. Energy was green. As a matter of fact, in case you missed it, out of the 11 S&P 500 sectors, energy was the only one in the green today. So we'll look at energy. I also want to look at financials because earnings start for financials next week, and we could be getting into some trouble there. All right, let's keep moving on here with this stream. I've got a bunch of stocks I want to look at, names that we looked at yesterday. I want to see how correct I was with some of them. One of them, though, it's not even connected to reality. All right, enough said with that one. Okay, let's take this screen right here. Let's get rid of it so we're not using up too much power here. All right, let's start with the S&P 500, ticker SPX on that one. All right. The main indices saw a lot of choppiness today, a lot of choppy action, and they remained pinned below their flat lines for the entire session. The S&P 500 closed just below the well, actually, it's ticked up. 3808 is where it closed. So right around that 3800 to 3810 level, 380 on the SPY. Just about, that's where it stopped. That's where it closed today. And if you notice here on the screen, our support line that we talked about yesterday in this ascending triangle right there, you can see that candle stopped and closed perfectly right on it. And of course, yesterday, the top resistance line or the flat line to create the ascending triangle, yesterday's close was right at the top of that resistance line. So we are in this narrow trading range where this rising or ascending triangle is playing out. We are seeing it play out live here. So what's the play tomorrow? Well, we may have a clue. When we go look at the QQQ, the NASDAQ, it broke down. It broke down. In this ascending triangle, when you have a neutral 5-period moving average, when you look in tighter, like the 15-minute time frame, then you know what's about to take place. Unless there's some crazy headline, right? That can just blow things up completely. Now, this morning's economic releases, that's what stoked a bunch of concern with market participants, putting a bunch of trouble and headwinds in this market. Let's look at that 15-minute chart. While we talk about this, I'm going to get the chart situated here. But market participants were concerned about the Fed's rate hike path. Yep. And a potential policy mistake triggering a deeper economic setback, which drove today's broad-based retreat, just like we saw on that heat map. Now, there was a stronger than expected ADP employment change that took place today. And boy, oh boy, that plus the December initial jobless claims for week ending December 31st, which hit its lowest level since September. That indicated that the labor market remains tight. And at the same time, a sharp narrowing in the November trade deficit that was led by declines in both exports and imports reflected a weakening global demand. So the global economy is slowing down. We are seeing signs of it. We have been now, okay? You know this. Now, investors are acutely aware that the Fed considers a weakening of the labor market to be an integral step in bringing down inflation. So today's strong labor data left market participants fearful about the Fed continuing to raise rates and not entering a, quote, pivot to a rate cut cycle anytime soon. Piling onto those concerns, we had Fed speak today. Kansas City Fed president, who is not an FOMC voter, so they cannot put a vote for where rates are going to go. But anyways, told CNBC in an interview this morning that she sees the Fed funds rate reaching 5% and staying there, get this, well into 2024, just like we talked about yesterday during the live stream. Remember, the Fed minutes came out, right? And in that, if I could boil it down to one sentence, it was when market participants talked about not anticipating cutting rates in 2023. And then we get our first Fed speak of 2023 and her saying, no, we're not going to cut rates, not until we're well into 2024. That brought fear to the market. But it's not a surprise. We mentioned it yesterday. Also, investors are concerned about the other labor data that drops tomorrow. in the December employment situation report. That comes out an hour before the market opens. And that is going to be significant. We're either going to have a gap down like we typically have on these big data days, or we're going to have a gap up, right? Either the labor market remains tight and we get a gap down, breaking all these support barriers that are in and lined up perfectly right now. And we're going to go through the charts and we're going to talk about how they are lined up right now, much like we did yesterday, just so you understand where we are at this point in the game. Now, things did improve in the afternoon trade, in a move that coincided with the St. Louis Fed president, who's also not an FOMC voter, saying that the policy rate is not yet in a zone that may be considered significantly restrictive. And I get that. We're going to 5% plus on the Fed funds rate. We're not there yet. But the Fed official did say that we're getting closer. Okay. So we have one Fed official today, Fed speak, saying another 50 basis points. And then we have another Fed official with Fed speak saying we're not at the restrictive level yet, but we're getting closer. Do you see the clues? Let's pull this up real quick. I know I wanted to get onto the charts, but let's just look at this real quick. CME Fed Watch Tool. Google that in, first link right here. CME Fed Watch Tool. That's what you want to click on. This is what you want to follow. This gives you an idea of where rates are going to go, okay? It's why we can be so insightful when we're talking about this. All right. On your screen, what you're looking at, the next decision day for what's going to happen with the Fed funds rate is February the 1st. And right now, okay, right now, there is a 59.6% probability right here of going to 4.5 to 4.75%. So that's a 25 basis point rate hike. And then we have a 40.4% probability that we're going to 4.75 to 5%. That would be a 50 basis point rate hike. So right now, it's 60-40, 20 basis point rate hike 60, 50 basis point rate hike 40. That's where we're sitting right now for the very next meeting that takes place on January the 31st through February the 1st. So February the 1st is the decision day. Now, I want to go down here and show you what changed since yesterday, okay? This is what changed since yesterday. With the Fed speak that we had today, this is what changed the probabilities. So 1 day ago, the probability of a 50 basis point rate hike was at a 69.7%. That has, my apologies. I need to take a step back. Okay. Yesterday, January the 4th, for the 25 basis point rate hike for February 1st, FOMC meeting, there was a 69.7% probability. That dropped by 10% to 59.6% probability of a 25 basis point rate hike. Now, the 50 basis point rate hike. Yesterday, that was sitting at 30.3%. That jumped 10% today due to Fed speak to 40.4%. So the probabilities here shifted more towards a 50 basis point rate hike at the February 1st meeting, okay? It's good to understand these so you can be prepared for February 1st and the rate hike decision and what the market's going to do between now and then. And again, just type in CME Fed Watch Tool. Takes you right there. You can see it. Now, if we go, because we can do this, we can go to the March 22nd meeting. So on March the 21st and March the 22nd, that will be the second FOMC meeting in 2023. Here's the breakdown, okay? We have an 8.6% probability of going to 4.5 to 4.75%. Okay? That's really, really low. And then we have a 56.9% probability of a 0.75 to 5% going to that target rate. And then we have a 34.6% probability of going to 5 to 5.25%. So this middle one is representing a 25 basis point rate hike. So both the February 1st meeting, the higher probability is on 25 basis point rate hike. March 22nd, the higher probability is towards a 25 basis point rate hike. And that's what we're looking at. That's what I think we're going to get. We're going to go up and we're going to be at 5%. And then the Fed's going to hold rates at that interest rate. And for how long? Well, the quote we got today was not until we're well into 2024. Let that sink in for just a moment for the probabilities of what the Fed is thinking. That drove markets lower today because that's not priced in. All right. And then earnings start next week. Now, the markets started to try to price in earnings, but I don't think it's going to be very successful until we actually get that first day of earnings, which happens next week. We also get CPI data next week. Next week is going to be chaotic, to say the least. All right, let's look here. This is the S&P 500, ticker SPX. We've got 1, 2, 3 trading days here of data to look at. Now, what I'm pointing out, okay, is right here is the lower ascending trend line of support, all right? We tagged that 2 sessions ago, so on Tuesday. Yesterday, we ran up and we tagged the upper end of that flat trend line for resistance, making the ascending triangle chart pattern. Today, we came down, flirted on that line, broke through it for 30 minutes or so, then traded around it again, and then we ended the day slightly below that support trend line, all right, in the ascending triangle, all right? So if I can get real quick this chart cleaned up, I'm going to go back real quick to the daily just to show you that if we get bad data tomorrow, okay, bad data tomorrow, then we are set up right now to break this ascending triangle. This is today, right here. We closed just below that support line. This is important, right? We've tagged it before. We've tagged it with just the wick of the candlestick, not just the body. And then we have our top line support up here that we closed on yesterday. So if the data that comes out tomorrow, okay, and we've got a lot of data coming out tomorrow, the big one is non-farm payrolls. the unemployment rate. Those are big. And then look down here at the bottom. Fed speak, Fed speak, Fed speak, Fed speak. We get 4 more Fed officials talking tomorrow. It's going to be a wild day. And we are sitting right on that support line where we can just break right through. Because remember, on this chart pattern, all right, let me pull it up just to refresh, bottom left corner, we have the flat top, okay? And maybe it's better if I draw it out as I'm saying it, just to make it clear. The ascending triangle, you have the flat resistance top. You have the ascending support at the bottom. It is a neutral chart pattern. You can break to the upside, you can break to the downside. But right now, in reality, we are sitting on the support line. And if we get bad data tomorrow, either from one of those 4 Fed speakers, or employment data comes out and it shows employment got stronger instead of weakening, we could break right through that line. And there's our breakdown. There would be our expansion move that we're looking for, that we're anticipating, that we're expecting to happen. Okay. Look, you know it. I say it all the time. Expansion leads to contraction, leads to expansion. All right. We're on the cuff of that happening. That expansion move. We've been consolidating now for nearly 2 weeks. Okay. Let's keep moving. Let's see. Ooh, I don't want to miss anything that you're saying over here. I don't see any change in gas and food prices. My guess, CPI could be the same, a little higher. You've got a great point there. Okay. A great point. However, core CPI is what the Fed looks at, pays attention to, more so than the actual CPI number. And what does core exclude? Energy and food. So you can have CPI data that is sticky, that is staying elevated because of those food and gas prices not coming down. But then when you take them out, well, the housing market has started to come down. Other items have started to come down. Core CPI may show that inflation is coming down. So we have to make sure that we're prepared for those 2 scenarios, for what the Fed pays attention to versus what all the headlines are going to say, right? Okay, let's keep moving on. Today's, on the 5-minute chart, the volatility, the little bounce we had, it was over quickly, all right? And we were back to down on the S&P, 1.2% at the closing bell. The Qs were down 1.6%. The Dow was down a whole percent, and IWM was down a whole percent on the day at the closing bell. The dollar, the 10-year and the 2-year yields, something interesting happened. There was another headwind for the equity markets today, which was increased selling in the Treasury market, which put pressure on equities. Let me pull up the 10-year for you. And then we'll go SPY, Qs, IWM, and then we'll look at the individual stocks, all right? Here's the 10-year, all right? The 10-year hit 3.78% earlier today. Then it settled the session at 3.72%. So a very small fractional move in the 10-year. it's staying in its trading range right now. But the 2-year, though, the 2-year yield acted completely different. Let's open this up and bring it down a little further so you can see what I'm talking about. Right there. The 2-year rose 8 basis points to 4.45%, shooting right out of its chart pattern. This caused market participants to worry a bit. What is the 2-year yield most sensitive to? It's most sensitive to the Fed funds rate, interest rate hikes. The 10-year is more sensitive to growth and inflation. So with the 2-year spiking like this, that's saying that market participants think that interest rates are now going to go up. The Fed funds rate is going to go up, maybe more than what they were betting on. That's what this is showing us. And this put pressure on equities for them to come down today. Now, this is also important to understand for when the financials start reporting next week. Okay. Banks make money, all right, by lending long term and borrowing short term. And that spreads how they make their money. So an inverted yield curve where the 2-year has a much higher rate than the 10-year shows you that that's not good for financial companies. Your big banks, they can't make as much money. Their margins will be under pressure. And if you look at the savings rate right now, it's like down to 0 for most Americans. Savings accounts have been wiped out since the pandemic. Banks are tightening for their credit or for their loans that they're giving out in lesser numbers. I mean, the mortgage market is drying up rather quickly. So let me show you the financials, but real quick, let me just mention this, that 10 of the 11 S&P 500 sectors closed in the red today. Real estate, XLRE down 2.9%, and utilities, XLU down 2.2%. They were the worst performers. While energy, and we'll start there, XLE, I want to look at energy and financials, and I'll go through the main indices. Energy was up 2% today and was alone, all by itself, in positive territory. Now, real quick, let's look at this right here. This is XLE, which is energy. So we can see it's holding a very significant resistance line coming down. On the bottom, we could adjust this line up just a little bit. As a matter of fact, let me do that right now. This would be more realistic up there, okay? So it's respecting, we've got 3 touch points here, this support area, all right? Now, if this continues for energy and it gets tight right here, well, what is this? All right, let me show you on the chart patterns. Let me clear this drawing up. This would be considered a descending triangle, where the top line is descending, the resistance line, but the support line is flat. It's the complete opposite or inversion with what we're seeing in the SPY, the Qs, the Dow, the IWM. And this is also considered to be neutral, where it could break in either way. So energy is setting up to break either way, okay? And if we go back here and let me adjust this chart right quick for a long-term look, going back a little bit, you can see that, what does this match up with? The highs right there, right there. It kind of peaked over that one. And then if I go back even further, a little support there, not much, and then right through there, okay? So there is significance at this point for energy to hold up as support, because old resistance, right there, there becomes support, right? Old resistance becomes new support. Plus, we've got that 200-day moving average slowly creeping up to where the current support line is for energy. So this is a key sector to watch while we're trying to figure out, well, how low are these markets going to go? Okay. This is a key one to watch. Another one that's key to watch, XLF, which is the financial sector. Okay. Financials right now have their own pattern. They had their expansion move, and now you could say they're flagging, right? And what do we expect from here? Boom. That's what we're expecting. I'm actually looking to short financials. And I think going into the earnings season with financials on track next week, it could work out really, really well. Now, when I say right here, right, price came down, it's contracting up, what happens? It breaks down, okay? And that's the exact chart pattern that we're seeing right here. You can call it a rising wedge, you can call it a flagging pattern, but the same outcome is true. Further breakdown for financials. That's what I expect. Okay. Let me clean this up here right quick. I don't like to leave the chart dirty because then when we come back with it, it's all messed up and we got to spend time getting it right, right? Okay, now let's dive into the SPY here real quick before we go to the individual stocks that we want to all look at. The SPY here, same thing. It is sitting right on the support line. It closed directly on it. Now, let's go to the 15-minute time frame, and I'm going to turn on the 5-period moving average so you can see what occurred with that today. Yesterday, we had the 5-period moving average start to go flat on us, all right? When that's flat, it's neutral. It means things can go either way. Now, with today's downturn, it is pointing down again. It's moving down, and we are sitting directly on that support line. You can see it. We held up there today, just like with the ticker SPX when tracking the S&P 500 for about 30 minutes. We were down underneath of it, and then we doodled around and then closed directly under it, like just a few tenths of a point underneath that support line. And with all the data that's coming out tomorrow, this does not look good. This setup that we are in right now looks awfully nerve-wracking to me. Because if the data is bad, if it's perceived as bad, if the employment data is strong, then market participants, just like today, just like we saw today, are going to think, oh no, the Fed is going to have to take rates even higher than we're expecting right now with the probabilities that I showed you earlier on the CME Fed Watch tool. And what's going to happen? We're finally going to get that breakdown from the ascending triangle. It's right there. It's all in writing for us. All right, let's go to the Qs. Let me just real quick take these highlighters off. All right, we'll go to the Qs. We're on the 15-minute time frame here for the Qs. And, yesterday the 5-period moving average, it was still tilting down, which gave us a negative bias. It looked like it wanted to start to flatten out, but no. Then we get to today, and it's definitely moving down. And if we pull a few more days in, it's definitely in a downtrend. So you want to have a bearish bias on the Qs. And look what happened with the Qs today. All right. Let me pull this up real quick because I want you to see this blue support line right here, right here. Yeah, just above my head. You can see it. This was December the 29th, Wednesday. Also, I guess the closing of Wednesday and then the open on Thursday, December 29th, and we had that big gap up. We were underneath this support line just barely for, what's this, 5, 10, 15, maybe 30 minutes, 45 minutes at the most. And then we get here, right? 30 minutes below it, just below it on January 3rd. That was Tuesday. We have a couple wicks that got below it. And then we get Wednesday, January 4th, and it's just holding as support again right here, just holding as support. And then we get to today, and what happened? We broke right through it, and we did not even come back up to back test it. We just stayed down low, breaking below. So if you want to look at the main indices, the SPY, the Qs, the DIA for the Dow, and the IWM for your small caps, Russell 2000, the Qs broke. The first one broke down. There's 4 left. And they are ready to break. It's like a dam that is starting to crack. Now, I could be wrong. I could be proven wrong. If the data comes out tomorrow and it's sunny and cheerful, then woohoo. Then we could bounce, right? Right now, this market is so jittery and so walking on ice. That data drives everything right now. Headlines drive everything. All right, the Qs on the daily. So you can see this on the daily chart right here. We're looking at the ascending triangle. We had the flat top right there. We had the rising support right there. What happened? We broke down today. This is what the SPY, the SPX, the DIA, the Dow, the IWM, this is what they could look like tomorrow, because they're all sitting right on that support line, the ascending support line for the ascending triangle. Okay. Now, let me clean this up. We'll go to the DIA for the Dow so you can see this same thing. Staying on the daily, and I'll try to go through this one pretty quickly because it's straightforward. The Dow closed just off of that support line, and yesterday it was right on the support line. I'm sorry, right on the resistance line. So we go from resistance right to support in one day. And now with the data coming out tomorrow, if it is negative, then we are going to drop. We're going to drop down. We're going to break through that support. And that's what I want you guys to be set up and ready for. Okay. All right. Let me go to, after I take these 2 marks off, let me go to the 15-minute time frame so you can see in context with the 5-period moving average on this smaller time frame. You get the big picture view, and now the close-up under the microscope. We have the 5-period moving average. It is in a downtrend. That puts you in a negative, a bearish bias on a short-term time period. And you can see that on this 15-minute time period right here for Thursday, okay, we flirted around a lot with that support line today. Broke underneath of it for about an hour or so, and then came down to it again at the close, but bounced off of it. So we are sitting just above that support line. If the news is negative tomorrow, boom, we're going to break down through it, just like the Qs did today. Just like the Qs did today. Okay, let's go now to the IWM, and then we'll go look at the individual charts plus the dollar. We have to look at the dollar. It broke out today, so we got to look at that. All right, 15-minute time period here for the IWM, and you can see we went from, basically flat to slightly going up to now, flat to slightly going down. So we're still kind of in this neutral bias at this moment in time for the IWM. However, look at how it's acted along the support line. It closed just below it today. It is ready to trigger and fall. That dam is about to burst open. If the data is negative an hour before the market opens tomorrow with the employment situation, if employment is strong, market participants are going to see that as a oh no moment. The Fed's going to have to take the rates higher, maybe faster. Maybe instead of 25 basis points, 50 on February 1st. So that's what we have to watch. That's what we are prepared for tomorrow, okay? And that's all my goal is tonight, is to get you prepared for the potential breaking of the floodgates tomorrow. All right, now that we did that, we'll go to the dollar, and then we'll go to the individual stocks. I definitely want to look at them. A few that we looked at yesterday that I made a call on, and I believe all but one of them came true. All right, the dollar on the 15-minute time period, you see right here the 5-day moving average, and this is on the 15-minute time frame, so it's a 130 period moving average. It is inclining. So in the short term, you should have a slight positive bias on the dollar to a potential bullish bias on the dollar at this particular moment in time. Remember, this is fluid. This moves. It changes. This is what we're prepared for right in this time. All right. You can see that big burst up today. And when I go to the daily, you're really going to see it. Let me adjust it here right quick. That big, strong breakout of that channel that it's been in right there, right here. It's been moving sideways to slightly down. We had this falling wedge pattern, or, maybe you see it a little bit differently. Maybe you just saw it as a declining trading channel or a descending trading channel. That's fine. Either way. But we've been moving sideways after that. We got that breakout today. Guess what the dollar is ready to do? The dollar is ready to burst up, tag that 200-day and 50-day moving averages. Okay? We could potentially, let me adjust this chart here a little bit. Oh, I gotta get the highlighters out of the way. Hold on. Let me get those highlighters out of the way so you can see it a little better. What happens, or what is it called? Okay. Here we go. All right. The dollar reached its peak. It reached its high right back here in September. Lower high, and then it finally broke down, and it's been moving down sideways. We've got the 200 period moving average, which in 2022, going all the way back to when it really broke loose, this was June of 21 and July of 2021, busting the doors down, and it's just been running ever since. Now that we're under that 200 period moving average, we've got the 50 period moving average right there, the 200 right there. And where is the 200. It's at 106.31 right at this second. And we're at 105.13 in the after hours. And it closed today at 105.13. So it really hasn't moved any in the after hours. So we could very easily see that push up to 106.31 tomorrow if we get that negative data set, okay? And remember, the inverse correlation for the dollar and the S&P 500, the SPY, the dollar and the Qs, the dollar and the Dow, all right? Negative correlation, inverse correlation. When the dollar goes up, the S&P 500, the SPY goes down. And with that breakout today, we could be very well on a path to a stronger dollar, at least going up and testing that 250 period moving average right here, right on that. You can see them, right? Right here. Perfect. Okay, let's go look at some of these individual stocks. Let's start with Meta, META. Remember, if you have a question, plug it in. We can talk about it. All right, plug it in. We can talk about it in the comments. All right, Meta. Yesterday, what did we say? I said that Meta, since it reached its upper weekly expected move, that we could see it move sideways. And what did it do today? It was down 0.3%, and it came and landed right on its weekly expected move. So that one, I'm going to say, was accurate. I'm going to say that was an accurate call on Meta and its movement. Next one that I want to look at is Netflix. NFLX. And remember, if you have one that you want me to look at, put it in the comments and we will do so. All right. Netflix, this is a momentum mover, but it reached the upper end of its weekly expected move yesterday. Okay? So today, same thing as Meta. I said once it reaches that once it reaches that weekly expected move, it typically just doodles around on that weekly expected move. Look right here. Today it was up 0.09%. Now, I have to admit, earlier this morning, because it's got a bigger wick on there that, it really launched up, but sellers stepped in to push it back down, which typically happens when it's playing around that weekly expected move. The opposite when it's down at the lower weekly expected move. That's what happens. It'll doodle around. So tomorrow, what could take place? Well, it depends on the data, right? Because we got big data coming out tomorrow, an hour before the open, and 4 Fed speakers tomorrow to deal with. It could either doodle around on this upper end of the weekly expected move, which is at 308, or it could come down. All right. Okay. Real quick, let's go to Tesla. TSLA. All right. Tesla was down 2.9%. And where did Tesla end yesterday? Same thing as Meta, same thing as Netflix, but on the reverse of it, its lower end of its weekly expected move, which is at 109. It was down 2.9% today. It just doodled around right on that weekly expected move. So I'm going to say this was a call also. I'm going to say this one was accurate too. And then let's look at Apple, AAPL. I see AMD will go up. We'll go over to AMD too. Apple was down 1% today. Now, it is still within, okay, let me open this up just a little bit, bring it up. Apple is still within, if you want to call it, this falling wedge pattern. Maybe I could come up with something a little bit better in the short term. It stayed connected to its 5-day EMA, even though it dropped a percentage point, But where did it drop to? It dropped to just above its weekly expected move, which is at 124. And it closed at 125.02. So it nearly got to its weekly expected move and then halted. So Apple is one you should be concerned about. Because if Apple breaks down, Apple is going to pull a lot of ETFs, indices down with it. And if you look at this line that Apple is on now, let me go back to the last time we were here. You can see that this was an area that held as support for Apple the last time we were at this price point. It can break down. One thing to keep in mind, a lot of companies have already tagged their 2019 highs. And in some cases, a lot of them have already tagged the low of the pandemic in March of 2020. Apple has not. And if Apple drops, my gosh, it's a long ways down. There's the high in 2019, December of 2019. There's the low of the pandemic, March of 2020. If Apple came down to $80 a share from 125, that is a huge drop. But if you look at what Apple's been doing for the most part is right here. I'll go down this far to about 107, 105. Let's call it 105 on the bottom side of this. That lines up right, it lines up right over here. Move sideways, and then we could put another rectangle up top where it moved sideways when it was reaching its all-time highs. All right, right here. We can put another one up here. It already broke this sideways movement to the downside. Now, unfortunately, it could break this one and come on down to $105 a share relatively easily. And you can see there was a little support at that. But from that, if it breaks 105, $100 a share, watch out for $80 a share. Just like I was talking about with Tesla and its bigger scope play that it could be making. Okay, let's go to AMD. Yeah, Netflix was dumb today. I see that. I see it. Absolutely. All right, let's go to AMD. On the chart, AMD. Wonderful. And here, this is actually a good example. I'm glad we went to AMD. If we go back to March 2020, the lows right there, and then we just go back a little bit further, this was the high in February of 2020, and then it moved sideways right here, starting in April of 2020 all the way through July 2020, okay? If you look at that, that matches up with the low period right here for AMD back in October of last year. October of last year, it hit its pre-pandemic high. That's important to understand. For a lot of companies, they've already done this. But looking at Apple, Apple has not. And with such a heavy weight, Apple is in so many ETFs. Apple can do some serious damage to the overall market. All right, let's dive in here and look a little closer. I'll use the daily chart and then the 15-minute time period to look at AMD here. Just give me a second to update the chart so we can get dialed in, looking at what we want to look at here. Okay, now the downtrend for AMD, it's holding strong. That red line coming down there, it held real strong. Just like on the main indices, that's been held all through 2022. Now, if we look here, a drop of 3.6% today, that lines up with here and here. All right. The lower end of the weekly expected move is at 61. It's at 62. All right. It's about $1 away from its lower end of its weekly expected move. It could easily get there, super easily tomorrow. Okay. Especially if the data is bad. Now, I think AMD in the midterm, it's going to break the low that was set right here. Oh, where'd my highlighter go? It was set right here, okay? And that low, let me just get it correct, dialed in. It would be its 52-week low, 54.57. That is in AMD's near-term future, okay? Especially as we move through earnings season, which starts next week with the financial sector, okay? Now, if we dial into this a little bit more, what do we see here, okay? We see that it's really made this expansion move down, okay? And then right now, you know, it was kind of flagging, and today it kind of broke through that. But the positive thing is that it held these two support areas. So that's like its final bit of hope, if you want to call it like that. And if we just go back a little bit further to when it was down here the last time, going back to November and October, you know, look at this. It was basically a chop box right here. It would be super easy for AMD, not AMD, yeah, AMD. I was thinking about AMC for some reason. It would be real simple for AMD to come and get right back in to this chop box right here, because we got our expansion move down and then getting another expansion move down and then contraction, because expansion leads to contraction, which leads to expansion, which leads to contraction. It's the market breathing, taking those breaths. All right, let's clean this up and go into the 15-minute time frame. If you've got a chart you want me to look at, put it in the comments and we'll go check it out. And as a matter of fact, let me just do this so everyone knows where we are. All right, 15-minute time frame. Let's go take a peek at this. With the 5-period moving average adjusted for the 15-minute time frame. Let me drop this down a little bit. So you can see, all right, yesterday it was up here and it was just, oops, sorry. I need to get my highlighter. It was just moving around, hugging that 5-period moving average. And then we get to today and it drops. On a short-term time frame, that was the expansion, right? This was the contraction, and this was the expansion. The market breathing, okay? So we have, with the 5-period moving average, it was starting to try and level out yesterday, but today it's declining. So in the short term, we should have a bearish negative bias for where AMD could be headed for tomorrow, right? The lower end of the weekly expected move isn't far off. It's right down here. Again, at $61 and it closed today at 62. So it's $1 away to get down there. That could happen very easily. It could happen tomorrow morning. If the employment situation comes out, the market doesn't like what it says, or any one of those other data points tomorrow, unemployment rate, ISM non-manufacturing PMI, or any of the 4 Fed speakers tomorrow, any one of them can upset the apple cart and cause extreme pressure on this market that is ready to break down. It is ready to break down. Now, I'll be telling you tomorrow at the start of the live stream, if I'm wrong, I'm wrong. I'm not afraid to accept that. But this is what everything is telling me right now, okay? Everything I've shared in this live stream, it's what I'm seeing right now. All right, let me clean this up. We've got a few other charts to go look at. Let me just take this off real quick. All right, what is the next one we have? Apple needs to take a seat. Yeah, it's a scary one. Apple could drop pretty far. Oh, real quick before I go look at this. At the beginning of the live stream, I told you there was one that I completely missed yesterday. MULN. This one is, I don't think it's connected with reality. MULN. It was up nearly 25% today. All right, this is the daily. I'm sorry, 15. Let me go to the daily chart so you can see this. It was up 25% today. You remember yesterday I said, well, it's got to get above, this resistance line and close above it, for me to feel like anything could potentially positive happen with this. And I thought it was more likely to go down, but no, it did not. This one just is, I don't get it. I mean, short squeeze, yeah. Stock falls, cost to borrow, stock falls 80% overnight. I mean, this one, it just, to me, it feels disconnected from reality, moving like that. This was definitely a short squeeze. Definitely. And just real quick, I'm going to go to MU and Microsoft next. When stocks are moving like this is not predictable. At least in my book, these are not predictable. They're tough to understand because they're not playing by the rules. Okay? So you really got to be thinking outside the box. And if you got it, because I know someone in the comments yesterday called it, and props to you. I celebrate your call. You did a great job. I missed this one and didn't think that a 25% move would be possible on this stock. All right, let's go to change this up now. MU in that Micron. Is that Micron? Yes, Micron. Micron also had this big move right here. All right, daily chart here for Micron. Let me adjust this a little bit. See that Micron right now is really disconnected from its 5-period moving average, which makes me think, okay, this one doesn't seem stable at this particular point in the game. Micron entered into an incremental amendment number 1 to term loan credit agreement. Okay. Western Digital merger talks. No, that's not it. Qualcomm leads chip rebound as semi-stocks see broad-based gains. No, that's not it. I don't know what caused Micron to jump like this. I don't know if it had something to do with this incremental amendment number 1. to term loan credit agreement. I mean, I guess maybe this is the reason. I just don't know. Yeah, I have no idea the reason for this move. But anyways, the move was made, okay? So we got to respect that. All right, let me just adjust this chart right quick. I want to get this, I want to get a feel with the overall trend line here. So we're going to start, nope, can't do that. That one doesn't work to reach the overall trend. So let's go here. And if we drop it down, you know, it doesn't catch there. Let me see here. All right, this may give us some insight. Just not enough. Let's see. Okay. Let me clone that line and bring it down here. All right, that line's up there. All right, now let's go in and take a closer look. All right. All right, so it looks like it's trying to find support down here, right? And it did it recently right here around its earnings. Right in that trading channel, this big gap up. See, this is a move that I don't think it is sustainable. Up 7.6 and then up 1% today. This to me it's not sustainable. This one's going to have to come down. And if you look at the candlestick for this one today, there's no wick on the bottom, but there's a good amount of wick up top, meaning that sellers stepped in at, actually, let me go with a trend line. Sellers stepped in at this particular point right here. Just like that. Use red, that's resistance. So sellers stepped in and pushed it right back down. Looks like that's its 50-day moving average that it tried to crack today, but closed right underneath of it. So it's in a zone right now where there's been a lot of chop before, okay? We can run this line right here that captures the gap up, okay? And I'll just change that to blue for now. And you can see the amount of chop that occurred. Just look right back here, a huge amount, and right here, just chopping around in that range. So I could see this starting to either move sideways or start to pull back, all right? And come down, because this 5-day moving average, it's got to reconnect. And 2 to 3 days is the typical amount of time that it can stay disconnected, except in the case of extreme moves. And we literally just had an extreme move right here with this giant gap up. So when we go in and take a closer look, let's go to the 15-minute time period. You're going to see how we should be looking at this move by paying attention to that 5-period moving average. Let's just do this. Okay. So the 5-period moving average, we've got today right here, it's inclining. All right. That shows that we should have a positive, a bullish bias. However, it is hitting some sort of resistance up here, right around the $55 a share range. On Wednesday, it was also pointing up the 5-period moving average. Again, a bullish positive bias. But the day before, you can see that it was moving flat. That's more of a neutral bias. And then before that, it was declining. That's your bearish bias. But at the tail end of the bearish negative bias, that's when you start to get it leveling out, and you can see the bend there. It starts right here to bend to level out some. And that happens in your sideways moving market. So right now, I think it's up against resistance. I don't think it's going to go much further than this, especially if the data tomorrow can't corroborate a move like this. And it could just end up moving sideways back in that zone that it's been in a couple of times, going back to October of last year, November of last year, and then December of last year. So that's what I'm seeing there with Micron. All right, let's go to Microsoft, MSFT. Got Microsoft there. Give me a quick second. Okay, Microsoft, big breakdown over the past 2 days. This could really be a sign of things to come, especially when we're talking about Apple. All right. That low right there, what is that, 213 a share? Yeah, 213 a share. It has broken below its weekly expected move. So Microsoft, it's not just looking for your typical weekly move. Microsoft is going for a 2 sigma move. And it's a safe bet to say if the data is negative tomorrow and the market wants to sink, you know, coming down here, 216, 217 isn't far off. Okay, that would kind of be like the first area, you know, to look at. Maybe as high as 220, because you have this right here and then this right here, and that lines up at the 220 a share. That could be a potential, because Microsoft taking a 2 sigma move, that's a big move in 1 week's time. It can happen. I mean, it's happened many of times. Let me zoom in here a little closer on Microsoft and show you this. This could be, you know, a setup kind of for, you know, what I'm seeing in the broader market, in the indices, where we had this flat top resistance, the ascending support, and Microsoft just completely broke down from that chart pattern there. So we had our, let me just bring this down a little bit. We had our big expansion move down. We had our contraction period, which led to expansion. So this is, you know, the same type of setup that I'm seeing on the SPY, the DIA, the IWM, and on a lot of individual stock charts, this same exact pattern. For Microsoft, it's just already played out, right? Okay. Let me clear this up. Now, the one thing about Microsoft, you know, it is taking an extreme move. So the 5-period moving average, I mean, it's pointing, you know, nearly straight down. And Microsoft on the RSI is at a 35. So it's not even in the technical oversold position yet, even though, You know, it dumped 4.3% yesterday and nearly 3% today. So Microsoft will probably chill out. Those were some pretty big moves. But, however, if we look at the overall long-term picture, just like we did with Apple, let me bring this back here. I want to go to March of 2020 and show you where Microsoft was pre-pandemic to where it is now. Okay, pre-pandemic February 2020 right here, and you know, it's sitting about $185 a share. $185 a share. That is not a far stretch if we have a complete and utter earnings mess. If we have a deep and dirty recession, seeing Microsoft drop this far is not out of the realm of possibilities. I know I sound really dark, and you know, there's a lot of doom and gloom in tonight's live stream. I understand that. I don't want you to take away that I'm like this over big bear on this market. I'm trying to be a realist on what to expect. Okay. All right. And then the 2020 bottom here for Microsoft is right around 135 a share. So, you know, I don't know if it'll get that low, but coming in and tagging that pre-pandemic high, that's a possibility. Another possibility too, which is just slightly above it, this support right here that occurred through July and October of 2020, you know, has a support area right around that $200 mark. That is a psychological level around that $200 a share mark. Whenever you get to whole numbers, there's always a psychological element to it. So that's another area. So between 200 and you know, 185 a share, that could be in the future for Microsoft, and maybe that's the absolute low that we get for 23 before things turn around and start looking like sunshine. All right, let's see what's up next here. You know, one more thing just to reiterate. I don't remember if I said it. With Microsoft being, you know, really stretched at this point in time, you know, giving up so much, you know, like a 2 sigma move in a week's time, it's liable to be one of the safer places tomorrow. I'm not saying it could bounce, but it could at least slow down. Okay. All right. Let's see here. Got that. And NLTX, there it is. It did. It had some magic today. It held up down 0.9%. Did I pull that one up yet? NLTX. I know I looked at it throughout the day and then getting ready to go live. NLTX down 0.9%. I think I called this one pretty good yesterday. Let's go in a little bit closer here. Oops, don't disappear on me. There we go. All right, I got to open this up and then I'll raise it up. Get a good picture here on it. And while I'm doing this, remember, if you've got a stock chart you want me to look at, put it in the comments and we'll do it. We will. Okay, opening this up. You know, that flat top resistance, it's still in there. There's an ascending triangle here that we can see, but it's also got some real sideways movement too. So this, you got that resistance right here. It's holding there. It's got a big wick for today. So that candlestick today, it closed right on this resistance line. There was a big wick over top. I thought I might have ended up being wrong on this one yesterday, but it did pull back. Sellers stepped in, pushed the price back down, and it is just holding there at that resistance point. But if it breaks down from here, okay, remember, this is a neutral pattern where you have your flat resistance top and your ascending support bottom. That's a neutral chart pattern, all right? Ascending triangle. We've been seeing them everywhere. And when we go in on the smaller time frame, 15-minute, and look at the 5-period moving average and how it's being respected with price action, it started to curl up today, which gave it a bit of positive to bullish bias. But, you can see that it didn't really move a whole lot today together. It had these spaces in it where it did nothing and then just completely shot up. But that 5-period moving average, we can go back to December 28, and it's been slowly inclining to almost being flat. And then if we really dive into it here at the end, it's starting to curl up. So this is giving you a little more of a positive bias, just a little bit. It is at resistance, okay? It's at resistance. So what it wants to do from here, support has held up. It's at resistance. The 5-period moving average is starting to incline there a little bit. Where's it going to go? It needs momentum if it wants to punch that resistance and blow through it. Otherwise, it's going to come right back down to its support line, right back down here. 50 cents even. We're closed at 50.56. 50.56. If it comes, gets rejected at that resistance, and it'll come back down to 50 cents even. That's what I see there. So slight positive bias there at the end, but it is at resistance, and it could just come right back down to that support level. Okay, let's keep moving on. MULN also did good today. Yes, it did. We looked at that. That one, it's in a short squeeze. It's disconnected from reality in my mind. Up 25% today. Amazing. Amazon couldn't half up bullish. Let's look at Amazon. I don't remember if I see. Amazon had bad news. So Amazon had bad headlines today. What was it? 18,000 or so employees being laid off. That hurt Amazon today. This is the 15-minute time frame for Amazon. If we tighten this up just a little bit, the 5-period moving average went from being neutral right here, moving flat, which gives you a neutral bias, so it could, break either way, to now it is slanting down, which gives you a bearish bias in the short term, 15-minute time frame. So you've got a negative bias there, short term. And then if we go to the daily view, we can see that it's dropped today. It's stayed connected with the 5-period moving average, so it's not a big move that it got disconnected. But the lower end of the weekly expected move is at $80, and the upper end of the weekly expected move is at $87. So it looks like it could be pulling down to maybe this prior area right here where it bounced from, which is right around $81. Just $1 above the weekly expected move on the lower end down here. So if that news tomorrow morning is negative, that could just send Amazon even send it down further, and that wouldn't be surprising to me. And if we look at, prior to this, we've got good overhead resistance right there. And then we had, kind of same pattern with this rising wedge. I'm sorry, ascending triangle, my apologies, right there where you can see it just broke through today. Kind of like the QQQ did, where it just broke down today from this same chart pattern right here, where we had our expansion move, which led to contraction, which now could be on its way to kickstarting another leg down, right there for Amazon. And then if we look at the bigger picture of Amazon and where is it in relationship to its pre-pandemic high, because we've got to use that data. We've got to use the pre-pandemic high because so many companies have reached that point, and so many companies have actually reached the COVID low, all right? And when we pull Amazon up here, okay, and we're looking at that, the 2020, it's below its pandemic low. Amazon is lower than it was in March of 2020. That was right here. So where's the next area of support? I mean, is it going to be, this area right here? And maybe, the top end being right there, that give it a zone, like $80 down to this support would be about $70 a share. Is that where Amazon's headed next? 70 to $80 a share? Is that the next move for Amazon? Right down there? It's not out of the picture. And then again, remind yourself, what did the chart of Apple look like? Apple is nowhere near its pre-pandemic high. So if Apple gives that up, watch out for the rest of the market. It's an ugly picture. All right. DXY 4-hour and 1 weekly is turning bullish for a retracement. Then it's going to go bearish. Okay, I think the dollar is setting up, absolutely setting up to go a little higher, okay? Because I think the SPY, the SPX, S&P 500 is going lower. This is the daily view. I'll go to the 4-hour. And, same thing that we have, that we talked about earlier here for the dollar. Let me move that right quick. And you can see that the dollar clearly broke out of its structure right here. Let me come up right here. And the dollar broke out of that right today. It broke out of it, and now it's kind of hanging out there. And what are we going to say? We've got is it flagging there and it's about to, you know, go higher and push up to these other potential resistance up here? That is a good possibility. I think it will, which is going to put heavy pressure on the index, the SPY, the SPX. BBBY, BBBY. Yep, I said it right. Bankrupt. Yeah, earnings did not look good. This company, 123Y, looks like it is just going to collapse. And this recession in 2023, zombie companies, companies that, you know, can't survive and quite frankly shouldn't survive, you know, they're going to collapse. They're going to go bankrupt. You know, look at this. This thing has gone down to $1.69 a share, lost 30% today. Horrible earnings. Horrible. Look at this. Just, oh my goodness, just destroyed. This is destroyed. This is Bed Bath & Beyond. You know, I like going to their stores. They're kind of fun, but, you know, as a company, they just couldn't do it. Couldn't do it. Not at all. Let's see here. I agree the DXY so puts and shorts will win for a few weeks. Yeah, I think that if you're going to put some, if you're going to go short on equities like the SPY, Qs, IWM, I think we've got more room, another leg to drop, and we are literally sitting right on the exit. Literally sitting there. Okay. All right. Well, I will wrap up the live stream for tonight. Do me a favor though, click that like button and share this video. That it's cliche, I get it, but it does help out. It does help out. Just remember, tomorrow we've got a lot of data and a lot of Fed speak to get through tomorrow. Non-farm payroll comes out an hour before the market opens. Unemployment rate, it's coming. This is big data coming tomorrow. This is a big econ drop tomorrow. And then we've got Fed speak, a whole bunch. 4 different Fed officials talking tomorrow. And the 2 that spoke today did not help the market. They hurt the market today. So you can see we are literally sitting right on the support line there, and we're ready to just break down from here. Okay, it could happen tomorrow, it could happen next week, but we are about to break loose. It is going to happen. All right. Thank you, ladies and gentlemen, for joining me. I greatly appreciate it. I'll be back here tomorrow after the market has closed. We go live between 7:30, 8 p.m. Eastern, and we talk about what happened, why it happened, and what to expect going forward. I greatly appreciate each and every one of you. If you want more of the perspective, click the first link in the description or the pinned comment in the live chat. I'd love to have you in our investor community. So with that said, have a wonderful evening. Good luck tomorrow. You're absolutely welcome. And I'll see you in the next video. Good night.